Bloomberg Audio Studios. Podcasts, radio, news.
A treat on this special edition of Bloomberg Surveillance, Ed Yardeni for an extended conversation. Ed, I read your note carefully yesterday. Folks, I can't say enough about the value of subscribing to Yardeni's quick takes. You assessed the bond market. Should people that own shares be afraid of higher yields?
I think they should be concerned, but all in all, I think bond yields have normalized. I think that's important to keep that in mind. They were abnormally low between the great financial crisis and the great virus crisis because the Fed was manipulating rates. It was rigging the bond market with the short-term rate, the federal funds rate, being down to zero, and then, of course, quantitative easing. Now the bond market has been sort of liberated, free to tell us what the supply and demand in the credit markets really is. And I think we're back to where we were before the great financial crisis when bond yields ranged between 4 and 5%. So I don't think we should freak out about that. I think we should actually welcome it because it's a sign that the economy is doing just quite well.
You think, Paul, there's 4 people on the planet that agree with Dr. Yardeni?
So, Ed, I mean, given that backdrop, I mean, how do you think this Federal Reserve is going to proceed for the remainder of 2025?
Well, it's interesting. You know, the Fed just won't listen to me. I don't understand why. I don't understand why, but back in August of last year, we were saying, my colleague Eric Wallerstein and I were saying that the economy is resilient, it's strong, it's demonstrated that it could withstand a tightening of monetary policy. And again, I think the Fed not only tightened the monetary policy when they took the Fed funds rate from 0 to 5.5% between 2022 and 2023. I think they also normalized interest rates. Both the federal funds rate and the bond yield are kind of back to normal. So in August, we thought there was no need for the Fed to act, but they didn't listen. So they did not just 25 basis points, they did 50 basis points on September 18th. And we argued that that would probably lead to higher bond yields. And that's exactly what's happened. We've had the Fed funds rate down 100 basis points.
This is brilliant. Paul, I can't say enough about this. Overnight on LinkedIn, Paul Donovan of UBS, and he'll be with us, folks, in the coming days, like Dr. Yardeni, was collegially scathing about a Fed and the recent decisions.
Exactly. So, Ed, I mean, how are you...
Let me just answer your question. The bottom line is, I think they're definitely on pause. That's the message we're getting from the Fed, and I think it may be none and done, or maybe 1 or 2 and done. But I think the Fed doesn't have to lower interest rates anymore.
As we just complete 2 years, 2023, 2024, of north of 20% returns in the S&P 500 index, Ed, how do you think about 2025 stocks, bonds, all that kind of stuff? How are you talking to your clients this year?
Well, technical terms, roaring 2020s, baby.
Yep.
I mean, so far so good. Back in 2019, we suggested that the decade ahead, the 2020s, could be the roaring 2020s. We noticed that there was a shortage of labor, skilled labor especially, and that there was a tremendous plethora of technological innovations that were actually useful, that actually work and are relatively inexpensive to implement, and that these technologies would lead to a productivity growth boom. We've had them before. This one seems to be much more sustainable and potentially much more significant.
Ed Yardeni with us, folks. A special edition of Bloomberg Surveillance. We're with you till 9 o'clock, where Anne-Marie Horton and David Gura will join from Washington with the services at the National Cathedral for James Earl Carter. Thrilled that Anne-Marie Horton and David Gura will give us their perspective on that. We are thrilled as well to give you Ed Yardeni this morning. I can't say enough about in October of, I think it was 2 years ago, Ed Yardeni, and Ed, I'm going to give credit to the great technician, Ralph Van Kampor as well, said climb on board equities.
My friend,
yeah. You maintain your enthusiasm, Dr. Yardeni. I looked at the lineup of hedge fund performance, and everybody hedged last year. Very few people were full Yardeni. Describe full Yardeni.
Well, full Yardeni right now is stay invested. It's hard for me to tell people who've been in cash to jump in here because the market isn't cheap. But if you've been fully invested, particularly in technology, communication services, industrials, financials, which is the sectors we favored, we would actually stay with them. I know they're not cheap, but on the other hand, their earnings outlook is really quite good. For the current year, we have $285 a share for the S&P 500. That beats all the other strategists on the street, and that's consistent with the Roaring 2020s idea of a productivity-led economic boom.
Ed, it seems like for 2025, given where the Fed is, i.e., probably a little bit, maybe a couple of cuts at most for 2025, it sounds like it's a year where earnings really have to push this market higher. Earnings have to come through. Do you have concerns about some of the earnings estimates out there for this market?
Well, look, not only does the Fed not listen to me, but the market doesn't listen to me. I would love to have a nice, civilized, gradual bull market from here that's driven just by earnings and not valuations. Valuations are not cheap. The Buffett ratio is at an all-time record high. The forward PE is around 22. Back right before the tech wreck of 2000, it was 25, so we're not far from that. I mean, information technology and communication services account for a whopping 40% of the S&P 500, and we know that 30% of the S&P 500 is the Magnificent Seven. Look, I don't think these stocks the Magnificent Seven are gonna go away. I think they're here to stay. I think they're gonna continue to account for high valuation multiple. I think they're gonna continue to outperform, but I'm also counting on the S&P 493 to do well. So my year-end target is 7,000 on the S&P 500, which I think can be driven mostly up by earnings.
Tell us about the linkage here of nominal GDP into revenue, which supports your earnings call, the margin call, the development of free cash flow. Do we have a buoyancy of 5% nominal GDP sustained?
I think so. I think, again, consistent with the Roaring 2020s scenario, I think that productivity, which is currently quadrupled from 0.5% at an annual rate on a 5-year trailing basis, it was 0.5% back at the end of 2015, and now we're at 2%. So we've already seen a significant productivity growth boom, but 2% is kind of average for the historical average. So what we're counting on is productivity to do a bit better than that, maybe 3.5, even 4%, which to some people might sound delusional, but if you look at previous productivity growth booms, that's what we got to. And we think we're going to get to that handily by the end of the decade because of the technologies that are available out there. I think 3% growth is kind of what we're at right now, maybe a little less than that on a year-over-year basis. 3.5 to 4% real GDP is possible. Add 2% inflation, and you get 5 to 6% nominal GDP.
I can't emphasize enough, Paul, how alone Yardeni is on this. There's some bulls out there. John Stolfus.
I'm alone, but I don't feel lonely.
You don't feel lonely, but the idea that we're going to sustain 3% real GDP, how many guests are telling us that? It's a pretty lone call.
Exactly. Hey, Ed, what are you suggesting folks do in the fixed income market? Because a lot of folks feel pretty comfortable at 4.25% in 2-year Treasury. Do they need to take credit risk?
They don't really need to take credit risk, and I welcome that. I think that's, again, normalization. We should have an economy where if investors don't want to take risk, they shouldn't be punished with 0 to 2% yields on their money market funds. I think they should be getting a reasonable return, and 4.5% is certainly a reasonable return on a 2-year. On the other hand, people who want to lock it in can certainly go for the 4.5 and higher percents that are available in the capital markets. So you don't have to take risk, but there's greater reward, obviously, if you're willing to go extend into the bond market, go into the corporates, maybe even into the high yields.
Ed Yardeni, thank you so much. Greatly appreciate it this morning. Edward Yardeni there with a call of 7,000 XPX. I didn't, in my head, I'm sorry, I can't extrapolate on the Dow Jones industrial average, but it's a big number.